Hi, accounting class. It's another great day to do accounting. Today we're going to be looking at Chapter 2. We're going to find out Chapter 2 is one of the most important chapters in this course. We're going to go through journalizing transactions, posting them, and then creating a trial balance. So basically the first three steps in the accounting process are right here that we're going to cover. First, it's talking about the difference between events and a transaction. It says a transaction must involve a measurable financial change that involve two or more parties. There are some events that business happen that aren't transaction. The only example we're going to see is if they hire an employee. Hiring an employee is not a transaction, it's just an event. It's not until the employee starts working for us do we need to either accrue for their wages or eventually pay them. Then that becomes a transaction, but hiring them in itself is just a business event. All right, normal balances. We know these from chapter 1, right? Hopefully we do. Asset normal balance is a debit, liabilities normal balance is a credit, equity normal balance is a credit, revenues normal balance is a credit, expenses the normal balance is a debit, dividends the normal balance is a debit. Let me go ahead and give you an example of each different type here. So it goes through cash. The cash account is an asset account. Therefore, it's going to follow the rules of assets. It's going to be increased with a debit because that's its normal balance. The normal balance is the side that increased it, so it's increased with a debit. It's decreased with a credit. So the opposite one decreases it. So every time a business receives cash, it will debit the cash account. Every time a business pays cash, it will credit the cash account. And we're going to get to journal entries here in a little bit, and we'll see how we actually journalize the debits and credits. Alright, accounts payable is a common liability type. It's a liability account. Normal balance of all liability accounts is a credit, so therefore it's increased with a credit. And it's decreased with the opposite, is decreased with a debit. So whenever they purchase an item on account means we didn't pay in cash, we're just going to owe somebody money. So we purchased something from them, they sent us the item, now we owe them money. So anytime we purchase an item on account, accounts payable will be credited. When a business pays off what they owe to the other party, then we will debit accounts payable. Common stock is a common equity account. Equity, the normal balance of equity is a credit, therefore it's increased with a credit. I've crossed out the other one, it would be decreased with a debit, but that just really never happens. I mean, not never, but just you're not going to see it in this course. It's very rare. It's usually not debited. Alright, we're going to get to the next one, the income statement items. So we covered the balance sheet items. Next we're getting into the income statement accounts. Grooming revenue is an example of a revenue account. Therefore, revenues have a normal credit, so it's going to be increased with a credit. And we generally never decrease a revenue account. Generally it only increases. It would only be debited maybe if there was a mistake made, or when we get to chapter 4 we're going to go through the closing process. That's when we would debit the account. But for right now you just think grooming revenues increased with a credit and we're fine. Expenses have a normal debit balance. Therefore it's going to be increased with a debit. And generally they're not credited unless we're closing out the account or an error has been made. Dividends are the only type of dividend account we know. Dividends have a normal debit balance. Therefore they're going to be increased with a debit, and generally they're not decreased at all unless an error has been made or we're closing out the accounts. Alright, next page we have a chart of accounts. The chart of accounts just lists out every account that a business has, and it organizes them in some ways. We can see the accounts here. And the real world accounts have numbers, but in this course we're going to use their name to refer to them. These are important to us because you're going to see a chart of accounts on the homework often whenever you're journalizing transactions. This one happens to be an image, but when you're on the homework, the cool tip I could share with you is you can copy and paste. They're actual tables, so you could highlight this, copy and paste, so that way you can avoid the spelling errors. But you're going to see one of these on the homework. They just list out every account that a business has, a chart of accounts. This post ref we're not going to worry too much about. I'll show you one example of how it works and then we won't use it ever again. Alright, they're in this order. Anytime we list out accounts, we put them in this order. Assets first, the balance sheet items first. Assets, liability, equity. I'm throwing in dividends here. They're almost like an equity item whenever we have them on a trial balance. I want to show them in that order. So we're going to have the 3 balance sheet items. We're going to have dividends next. And then we're going to have revenues and expenses at the end. This is going to be the same way when we see a trial balance. We're going to order it in the same way. So it's the same way here on the chart of accounts where we have assets, liability, equity, kind of including dividends as kind of equity, even though they're not technically an equity account. They would be by themselves over here as dividends. All right, first steps in the accounting process. So first a transaction occurs. Once that occurs, we're going to journalize the transaction. We're going to journalize it in something called the general journal. These are all electronic nowadays. They used to be on paper and it was called a general journal. Now it's still called a general journal. It's just electronic. Next, we will post the ones that we journalize to their individual ledger accounts. Here you could optionally use T accounts, but we're going to use ledger accounts for this example. But you might see we're going to use T accounts in later chapters. So either one, ledger accounts or T accounts, they do the same role. And we'll get to that when we get to the second step. Third step, we're going to prepare a trial balance. So just like the name of the title, journalize, post, create a trial balance. All right, so we're going to look at this for our company, Paws and Claws Pet Services Incorporated. So the first transaction here, Janet and Jordan invest her personal savings of $50,000 into Paws and Claws Services in exchange for common stock. So we're doing this accounting as if we're the business. We're not Janet here. We're the business. The business is receiving cash. So that's going to be one account that's affected. And to receive that cash, they're issuing common stock. So that's going to be the other account. So the first step here is always to identify what 2 accounts, or sometimes it's more than 2, but there's at least 2 accounts always. Identify what 2 accounts are affected. And here the business is going to receive cash and they're going to issue common stock. So cash is going to increase by $50,000 and common stock is also going to increase by $50,000. So let's think about cash. If we're the business, we're receiving this cash. Remember, cash is an asset, therefore it has a normal debit balance. So we need to debit the cash account. So here's the journal entry. First thing, we have a date. Date's given in the problem. Alright, so cash is going to be debited. Let's see how we record that. Cash was going to be listed here, and we're going to put it under the debit column, $50,000, because we're receiving $50,000 in cash. Cash is an asset with a normal debit balance. In addition, we've issued common stock. Common stock is an equity account, so it has a normal credit balance. So we're going to credit common stock for $50,000. I'll show you later this post-ref column and how it's used. It's really not as needed nowadays because computers handle this. That's why I'm not going to emphasize it much, but I'm going to show you one example later. For now, you can just ignore it. Alright, one rule here, every time we do journal entries, this always has to be true 100% of the time. Debits must always equal credits. Debits have to always equal credits 100% of the time. Computerized systems don't even accept your entry unless this is true. Alright, for our sake too, and for the homework, we're going to have to place debit entries before credit entries. This is more of an academic thing. In the real world, the journal entries do not matter. The debits before credits is more academic, makes it so much easier to grade, and the homework is programmed to accept the debit entries first. So we'll just get in the habit of putting our the account we're going to debit first, and then the account that we're going to credit after that one. You can also notice it's indented a little bit over. That's just common technique, common formatting to make it easier to read. An accountant can read this and say, oh, cash went up by $50,000 because they issued common stock. So it looks like the business issued common stock and received $50,000 in cash. Alright, let's move on to the second one. Janet prepays $9,000 in office rent for 3 months of rent that will cover for January through March. So what accounts are going to be affected here? Well, we're definitely paying $9,000 out. So cash is going to be paid out. Anytime cash is paid out, we need to credit the cash account. So we can credit cash for the $9,000 that we're paying out. Go ahead and put a date on there if we wish. Alright, here's the tricky thing. I could see you going in 2 directions, rent expense or prepaid rent here. Alright, In this example, they're paying it at the beginning of January, and it's going to last January through March. So in this case, it's not an expense yet because we haven't used up the rent. We're at January 1st, and this is going to last us for 3 months. So at this point, it's not an expense yet. It will become an expense over those 3 months. Actually, would take this 9,000 divided by 3 and expense 3,000 per month for the office rent. But we won't see that type of entry until Chapter 3. For our purposes here, it's going to be prepaid rent. Prepaid rent in cash. It's prepaid rent because we're paying it right now and we haven't used up the services. Over time it will become rent expense, but not right now. So we're going to debit an asset account called prepaid rent for 9,000. It has value to us, right? It gives us a place to do business. So it's an asset. So that's the example of that entry. Journal entry number 3, Janet purchases on account. Again, this on account word, right? That means it wasn't settled with cash. We purchased it, but we didn't pay cash yet. That means whenever we see these words, it's going to involve either accounts receivable or accounts payable. On this case, it's going to be we purchased it, so we're going to owe somebody else money. Therefore, it's accounts payable, not accounts receivable. But they purchased 2 types of supplies. Remember, they have 2 different revenue functions, the grooming services and the veterinarian. So they have supplies for grooming of $950 and for veterinarian supplies of $1,850. So this is the first one we're going to see that actually has 3 accounts. What we're going to do for these 2 supplies, they're asset accounts. Remember, when we buy supplies, they're an asset. As we use them up, they become an expense. So these 2 supplies accounts are both assets, they're both going to be debited. So we have grooming supplies and veterinarian supplies both debited for their respective amounts, $950 and $1,850. Alright, what are we going to credit here? They did it on account, so it's going to be accounts payable, right? Accounts payable. And we're just going to, debits have to equal credits, so this last number has to be the sum of these 2. That's the total amount that we owe. So again, we see that relationship where these 2 numbers add up to this one. Alright, journal entry number 4. Well, maybe not, right? Janet hires 2 employees, Karen and Paul, to begin working on January 8th. Both will be paid bi-weekly every 2 weeks. Karen is a recent graduate, blah, blah, who are earned $2,500 every 2 weeks. I'm just going to highlight it because we are going to need it later when they actually pay them. So this is the event, not a transaction. Therefore, there's no entry needed. But we will need these 2 numbers when we pay them 2 weeks later. Oh, that can be that way. They hire them and they don't start till January 8th. That works. Alright, journal entry number 5. Karen's veterinarian work exposes the business to legal risk. Because she can make a mistake on one of the animals, and then someone can sue them. Janet decides to purchase insurance to help mitigate this risk. She purchases insurance for $12,000, which covers the firm for 3 months. So we're going to see a very similar relationship as we did to the previous one where we had prepaid rent. This time it's insurance. It's going to become an expense eventually, but at this point it's not an expense. It's an asset because it gives us future value. It covers us from risk in the future. So we're going to debit prepaid insurance. In addition, we paid for it. This problem doesn't say anything about on account, so I'm going to assume it's in cash. So if it doesn't say on account, we can assume it's in cash. And it's for the 12,000 number given in the problem. Let's keep moving. Journal entry number 6. Paul already has a great reputation for grooming pets in local pet shows. Customer has agreed to pay $9,000 in advance for 3 months of service. Okay. Remember, revenue has to be earned in order for it to be recorded as revenue. So this amount is going to become revenue, but it's going to become revenue over the 3 months of service. It's revenue as we earn it, not revenue when we receive the cash. So the account we're going to have to use is called unearned revenue. Remember, this is a liability account. So the debit here is pretty obvious. They're receiving $9,000 in cash, so we have to debit cash. Remember, cash is an asset, so whenever we receive cash, we debit cash. The credit is going to be to unearned revenue. So we see the $9,000 in unearned revenue here. Debits equal credits. So this tells an accountant that we received cash that we haven't earned yet because it's going into unearned revenue, which is a liability account. And again, it will become revenue. Actually, you'll take 9,000 divided by 3. $3,000 of it will become revenue each month. At the next chapter, we're going to do that adjusting entry. But for now, we're just doing the basic journal entries in chapter 2. All right, Janet purchased equipment to be used in the business, which cost a total of $24,000. She pays $3,000 and signs a note. Okay, a note is a legal document. It usually has interest associated with it. So it's for 6 months. We're going to need all these numbers later whenever we need to accrue for interest, but right now we're just going to put the equipment on our books. Expected to last for 5 years, and she expects to sell the equipment for $3,000. So the residual value, that's going to be in chapter 3 as well. Alright, so what do we know most for sure? Sometimes we just treat this as a problem. We know the date's 1-6. We know we got equipment for $24,000. We know under the cost concept we're going to record that as the amount for the equipment. So we debit the equipment account for $24,000. We know that we paid cash of $3,000. We paid the cash, so it's going to be a credit to cash. Alright, but this doesn't balance out, right? The rest of the amount, it doesn't tell us the amount, but we can calculate it. 24,000 minus 3,000 is 21,000. And that's going to go to, in this case, we owe the note, so we're going to call it notes payable. So a transaction can involve more than 2 accounts. In this case, we see 3 accounts. There's no limit to how many accounts it can involve, but it has to involve at least 2. It can never involve just 1 account. Then the debits wouldn't equal credits. Alright, Paul provides grooming services on account for 1920. So this is part of our revenue function, right? We provided services, so we're going to get to recognize this amount as revenue. So we'll go and put the date. Revenue is a normal credit balance, so we're going to credit the revenue account. In this case, it's grooming services, or grooming revenue. Alright. On account means we haven't received it. Remember, it's going to mean either accounts receivable or accounts payable. In this case, since we provided the services, they're going to pay us, so it's going to go to accounts receivable. Accounts receivable is the asset account, so it makes sense that we're debiting it for 1920. Someone else owes us $1,920 to the business. All right, number 9, Janet writes a check for $1,850 to cover the veterinarian supplies purchased on January 2nd. So what 2 accounts are going to be affected here? Well, we're writing a check, so we're paying out cash. Sometimes you don't have to write the debit first, you just have to put the credit one second, right? So you can go and think, well, I know they're definitely paying out cash. It says that in the problem. And then we can think about what we're going to record here. They're paying this for veterinarian supplies, but we've already recorded, let's see how we recorded the veterinarian supplies. Veterinarian supplies, we debited and put it into accounts payable. So we're not purchasing them now, we're just paying the bill off. So what we need to do is reduce accounts payable. Once we pay somebody what we owe them, we no longer owe them that amount of money. So we're going to reduce accounts payable. Reduce accounts payable. Accounts payable is a liability. To increase it, it has a normal credit balance. So in order to decrease it, we're going to debit it. So what this transaction says is that we paid $1,850 out because we already owed the money to somebody else. So it's already in accounts payable. And once we pay somebody what we owe them, we no longer owe them that amount of money. So it's appropriate to reduce or debit accounts payable. Journal entry number 10. Janet writes a payroll check for Karen and Paul. Karen earns $2,500 biweekly, and Paul earns $1,800 biweekly. What 2 accounts are affected? Which one's going to be debited and credited? So let's think about this. Again, cash is usually the easiest thing. They're paying out cash here, so we'll go and credit a cash for the total. If you add up 2,500 plus 1,800, you get to 4,300. At least I hope you do. Yes, you do. Alright, so what are we going to debit? In this case, we're going to debit wages expense. Wages expense for 4,300. It's an expense item. These are employees who have worked for us for 2 weeks and we're paying them, so it's an expense of the business. It's part of their process of earning revenue. They have to pay these employees to work for them. So, all right, we'll talk about this for a second. It is acceptable to record wages expense when you pay the employees if and only if the total work pay period occurred in the same month. So all of it occurred in January, right? They started on the 8th, they're getting paid on the 19th. All of that activity occurred in January, so this entry is appropriate. We're going to see in Chapter 3 whenever it crosses over a month. So on the next pay period, they're going to start on the 19th, and they're going to work for 2 weeks, which is going to cross over the month end. In that case, we're going to need to accrue for their wages. In this case, we didn't need to accrue for the wages because it was all happened in January. So we want to remember back to Chapter 1, it's an expense when the business incurs the expense for an employee's, i.e. each day the employees work for us is technically an expense. It's not like they recorded each day for businesses. They record it either when they pay it, if it's all in the same period, or they look at it at month end and accrue for their wages. So they only look at the pay periods or at the end of the month. They don't actually do a transaction every day for wages. But theoretically, that's what happens. Every day that the workers work for us, the business incurs it. So it's not when the paychecks are written. We've only done it this way because they all occurred in January. Alright, Pause and Calls receives a cash payment of 5760. So even without reading anymore, we know we need to debit cash for 5760. Oh, no, because they received more cash. Then they also received $10,080 for veterinarian services. So you're going to add those two together. That's the total amount of cash. They're receiving this cash because they've earned it from grooming services or veterinarian services. So we're going to credit those two revenue accounts. If we didn't know what account, like exactly what they called it, would go back to their chart of accounts. That's where the chart of accounts is so helpful. Like if I didn't know if it was grooming fees or grooming revenue, let's see what they called it. They called it grooming revenue. So we'll use the accounts as they're listed in the chart of accounts. Alright, journal entry number 12. Pause and Calls pays a dividend of $2,500 to Janet. So again, I would hone in on the cash. We're paying out cash, so we need to credit cash. And we want to debit the dividends account. Remember, dividends have a normal debit balance, so we're going to debit the dividends and pay out the cash. Alright, what do we have? Basically one more transaction here. Journal entry number 13. Accounting supplies found that only 250 of the grooming supplies were left and 650 of the veterinarian supplies were left as of month end. So we're at the end of January now, only 250. So we've used up some of the supplies, right? What we need to do for the journal entry though is not journalize the ending balance. Journal entries always record changes in accounts. So they only journal entries record changes in accounts, not an ending or beginning balance. These are ending balance. And here I've already looked at the beginning balances. If we go back to the transaction, we'll see the 950 and the 1850 respectively. So we had 950 of grooming supplies, 1850 of veterinarian. So the life cycle of supplies or any other prepaid asset is that they are assets when we purchase them, but they become an expense as they are used up. Alright, so let's think about the accounts that are going to be affected. This is another 3-entry one. Alright, we could think about these supplies, right? Both of these supplies accounts, they're both assets. Assets have a normal debit balance, but we want to decrease the supplies, right, by the difference. So 950 minus 250 is 700. So we're going to credit grooming supplies by 700. Again, we want to record the change in the account. So we take the 950 minus the 250. This is technically an adjusting entry, which we're going to see in Chapter 3. So this is just one entry we've thrown in there to try to get you started thinking about adjusting entries. But it's technically an adjusting entry, which we'll cover more of in Chapter 3 because it occurs at the end of the month and is trying to get the books right as of the end of the month. Same thing for the veterinarian supplies. It started at 1850. It's down to 650. So we'll subtract the two numbers. You get to 1200. So we know here debits have to equal credits, so we know it's going to be the sum of these two. We know it's going to be $1,900. What account do we want to hit? Alright, so these are supplies. We've used them up. Anytime we use up a business resource, it's an expense. So we're going to debit, in this case, supplies expense. So we had supplies expense of 1900 representing the cost of the supplies that we've used up in January. So notice we recorded them as supplies initially, but as we use them up, they go out of the supplies account, out of the asset account, into an expense account. Picture of kittens because it's a veterinarian service. Alright, what we're going to do next, we're going to look at the posting transaction, but all I'm doing here is summarizing all the transactions. So this is nothing new here. This is just all we've covered in individual steps. And I'm going to show you on the next page. This is already going to be filled out. These are all just a summary of all the journal entries that we've recorded. Alright, so we've completed our first step, which is recording everything in the general journal. This is the general journal. All I've done is accumulate all the changes, all the individual transactions into one general journal. These post references I'll cover in just a second. Let's go and hide them for now. I'm only going to show you one example, and we're never going to do it. It's never going to be a testable thing for me. Alright, so what we want to do now is move on to the posting step. The posting step is almost 100% done by computers nowadays, so humans don't do this. We need to do one example to see how it works, what the computer's doing. What it's going to do is take every transaction that was affected. So one of the problems we have here is look at cash. It's affected here, 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 and many more spots, right? It's very hard just looking at this, what's the ending balance of cash? You're like, well, I gotta get my calculator out, that's an increase, that's a decrease, that's a decrease, and find everywhere else that cash was hit. So that's what the ledger's gonna do for us, is accumulate all the changes in an individual account in one location so we can determine an ending balance. It's very important here that we post journal entries once and only once. Depends how you're doing this, but I would mark a transaction some way to indicate that you posted it. So let's start with the first one. Cash was debited for $50,000. So we're going to go to the cash account. We can put the date as 1/1. And we want to debit the account for $50,000. Notice each account has its own ledger account. So this one, only cash is going to go in here, only accounts receivable transactions go here, only supplies here, and so on and so forth. Every account has its own individual ledger account. So cash, also, they have two different debits and credits here. The first debit and credit tells you what happened for that transaction. The second debit and credit says balance under. This is the balance after that transaction has occurred. So the first two is what happened, whether it was debited or credited in that transaction. The second one is the balance after the transaction occurred. So cash was debited for $50,000, so we're going to put that in the DR. DR stands for debit, CR stands for credit. Alright, this is the only transaction. It is also the ending balance. So this 50,000, there's no prior balance, so theoretically it would be 0 plus 50,000 equals 50,000. And we're done with the first one. I would mark this in some way. I don't care how you mark it, but I would mark it in some way to indicate that we've done it. Here, I'll just mark it green for now to indicate we've recorded it. Alright, let's talk about the post ref for just once. Back when we didn't have computers, or accountants didn't have computers, these transactions for especially huge corporations would be, thousands, tens of thousands transactions a day. So if we wanted to record something and post it, it's very handy to know what page it was on, because we wouldn't want to search through a 10,000 page document to find one transaction. So they wanted to mark what page it got posted to. So this post reference, going to account 101, that's the cash account. Now on here we'd mark where it came from. It came from journal entry, and we're going to say this is all page 1 of the general journal. So it came from general journal page 1. So it just gives you a way to find it. That's all post reference do. It's not that important because computers do this automatically nowadays. So I'm going to go and hide it and not talk more about the post references. Alright, let's keep going. You can do this anyway. You could accumulate all the cash ones, but I recommend just doing it in order. Let's find common stock. It needs to be credited for 50,000. Common stock. Find it someday. There it is. Common stock on the first, it needs to be credited for 50,000. And as a result, its ending balance is going to be a credit of 50,000. These two numbers don't always equal. This number is the ending balance. It just had a prior balance of 0, so 0 plus 50,000 equals 50,000. All right, let's do prepaid rent. Prepaid rent was debited for 9,000, so we go to prepaid rent. We debit it for 9,000, and that becomes its ending balance as well because that's the only transaction. All right, so we've recorded it. We'll mark it as recorded. We'll go down to cash. Cash will be credited for 9,000. So now we can actually see the interaction of the trial balance. So cash in this case is credited for 9,000. All right, remember debits and credits cancel each other out. It had a prior balance of 50,000 debit, but this account is being credited. In that case, they cancel each other out. 50,000 minus 9,000 is 41,000, and the debit one was higher, so it's going to have an ending debit balance of 41,000. So notice that this is the balance after the transaction. We started at 50. We lost 9,000 in cash, or paid 9,000 in cash, so we end up with 41,000 in cash. All right. Let's try one more, and then we'll be done with this. I'll show you the rest of them. Grooming supplies, debited for $950. It's the only transaction, so it becomes the ending balance as well. Veterinarian supplies was debited for $1850, and that becomes the ending balance as well. Accounts payable was credited for $2,800. So go to the accounts payable page. It was credited for $2,800, and that also becomes its ending balance. Alright, but I think you get the picture here. All we're doing is posting it to their individual ledger accounts so we can determine the ending balance of each account. I'm going to go ahead and show you the rest of the accounts. I wouldn't worry too much about the post reference. Accounts receivable, if you post everything, you should get to this number. For grooming supplies, we have one more adjusting entry at the end. Veterinarian supplies, same story. Prepaid insurance, there's one transaction that affected it. For equipment, we bought the $24,000 equipment. Accounts payable, we paid off part of that in one of the transactions, so it reduces it to only $950. Unearned revenue, remember the $9,000 we got in advance for providing services. Notes payable, we signed the note for the equipment, not all of it, but all but $3,000 of it. We paid $3,000 of it out in cash. But again, all we would do is continue down that list and check everything off and post it. Dividends, we had the $2,500 dividend. For grooming revenue, we had two types, the one we earned on account, and then also the one at month end that we got paid in cash. Veterinarian revenue, we just got the one at the end of the month. Wages expense, we paid the 2 employees in the middle of the month. So we got $4,300. For supplies expense, remember at the end of the month we've used up some of the supplies, so we recorded $1,900 in supplies expense. But you should be able to see the relationship here, and this shouldn't be a difficult step. This should be the most difficult is the journal entries. This should be a pretty easy step. Alright, the last step here is to create a trial balance. So this is the last step in chapter 2, is to create a trial balance. We notice it has a 3-part title that we're used to, the name of the business, what type of statement it is. In this case, we're calling it an unadjusted trial balance, and it has the date, in this case January 31st. What we're going to do is list out every account. They are in a certain order, but you don't need to know it for the quiz because it's going to be in the same order as long as you read this down and then go to the other side and read it down. So all I'm going to do is list out all the accounts in that order. So it has cash, accounts receivable, grooming supplies, prepaid. You see these are the first 6 in that order, and then these are going to be the ones on the right hand side all the way down to supplies expense. And we just list one number here on the debit or the credit side, so it won't be on both, it'll just be on the debit or credit side, and it's going to indicate its ending balance as of January 31st. So we're just listing this one number for cash. For every account we're going to do the same thing. We're going to list its ending number 1920 for accounts receivable. Grooming supplies ending balance is 250. And so on and so forth. Sometimes they're on the credit side. I'll show you one on the credit side in a second. So accounts payable, if we did it, it's 950 credit. Unearned revenues 9,000 credit. So we just put it on the same side that it's indicated on the individual ledger account. And then this is the part where I say cross your fingers and wish for good luck, because you want these to tie. If they tie, it means that your total debits equal your total credits, which is a good sign. It doesn't mean everything's right necessarily, but if the numbers do not equal, then an error definitely has occurred. So if the trial balance is not balanced, there's definitely an error somewhere. That means your total debits don't equal your total credits. If the trial balance does balance, it's a good sign, but it does not mean the accounting records are error-free. It just means that total debits equal total credits. That's all it indicates. This one we're calling an unadjusted trial balance, because in the next chapter we're going to make adjustments and call it an adjusted trial balance, where we'll make a new one after we do the adjusting entries. In the real world, they don't use these names. I've never seen unadjusted and adjusted trial balance. Everything's just a trial balance and it goes through different phases, but in textbooks they do, so I'm following that trend so we can tell the difference between the two. They're in the following order. We've already saw this on the chart of accounts. So we have the balance sheet items, assets, liability, and equity first. We have the dividends. It's almost like an equity account. It's going to close out to equity in chapter 4. So we put it here, and then we put our revenues and expenses last. One of the reasons they put their dividends right there is so that their revenue and expenses are last. And it's very easy to calculate net income here. All we need to do is add up these two numbers, which are their two revenues, and subtract out the two expenses, and we'll get to the net income for the business as of January 31st before the adjusting entries. There's really no summary for chapter 2. This is really the most important chapter. This is one where we're going to need to get practice on doing journal entries, because we're going to be seeing journal entries basically in every chapter throughout the course. So there's really no way we can summarize this information. That's really it for the chapter 2, and next time we'll have chapter 3, the adjusting process, where we'll see adjusting entries and make a new trial balance. So we're going to see basically the same 3 steps, except they're called adjusting entries. So until next time, we'll see you guys next time. Bye bye.